Hello, everyone, and welcome to the Wall Street Blockchain Alliance's special global webinar exploring the implication of spot Bitcoin ETF approvals. Lots going on, lots of great thought leadership, and we're very grateful to have you all here. A little bit of housekeeping before we begin. Obviously, please do keep in mind that this event is offered for information purposes only. Nothing should be considered accounting, investment, legal, or tax advice. And obviously, the opinions expressed during this session represent the perspective of individuals here, not necessarily the Wall Street Blockchain Alliance or the individuals' firms. Please do keep in mind this webinar is being recorded, and all attendees, please do avail yourselves of the Q&A function. We will be responding to questions a bit later on in the session, reserved about 10-15 minutes at the end. One little interesting update, we are probably going to 90 minutes. There's just so much great thought leadership here. We wanted to capture it. For those in the audience who couldn't join us for the extended time, hopefully you can, but if not, obviously we'll make the recording available as soon as we can. My name is Ron Quaranta, chair of the Wall Street Blockchain Alliance. It's a pleasure to be here with all of you. Looking forward to moderating and chatting with you all. David, I'm going to start with you. I want to give my panelists an opportunity to introduce themselves. David Brill, my partner in crime. I'm going to start with you, and then we'll go around the horn.
Great, Ron. Coming to you today from South Florida. Really great to be here with everybody. I'm looking forward to discussing this. For those who don't know me, I'm a managing director at FTI Consulting. I've worked in the space for approximately 9 years and worked on the first ETF filing.
David, thanks so much. We'll go around clockwise. Mr. Johnson.
Thanks, Ron. My name is Richard Johnson. I'm the founder and CEO of Texture Capital. We're a FINRA member, SEC-regulated digital securities broker-dealer. We help clients raise capital through tokenized securities offerings, and we have an ATS for secondary trading.
Richard, welcome. Josh, please say hello.
Hi, I'm Josh Klayman. It's a snowy day in New Jersey, so I'm here in New Jersey. I'm at Linklaters, and I'm usually based in New York, and I lead our U.S. Fintech efforts. Oh, Josh, and I'm also very closely associated with the Wall Street Blockchain Alliance for many years, and I chair a legal working group.
Welcome, Josh. Mr. White on the West Coast, please say hello.
Yeah, representing San Francisco out here. Hey, everyone, my name is Pat. I'm the CEO of Bitwave. We're the leading digital asset finance platform for companies that use crypto. So accounting, tax, all of that kind of stuff. Been an exciting few days in crypto. I've been in crypto for a long time, and this has been a callback to earlier, happier times, which has been really nice.
Pat, you and I used to go deep diving on some topics. I'm looking forward to getting into it with you today. And finally, representing our friends in the UK, Ms. Morsfield.
Hi, I'm Suzanne Morsfield. I'm the Global Head of Accounting Solutions for Lukka. And yeah, I'm based in London, but I cover the globe. And Lukka is a primary or secondary pricing source for indices in many of the ETFs that have listed. And so super interested in chatting with everyone today. Thank you.
Suzanne, thanks for joining us. I know it's a little later there, and the pub will be open when we are done. David, Richard, let me start with both of you. Obviously, it's been a tumultuous few weeks, and then last week we got the SEC approval of spot Bitcoin ETFs after much work, after much consternation, and a lot of rejections over the past few years. David, can we level set for the audience who are all professionals in the space? But let's discuss the importance of understanding an exchange traded product or an exchange traded fund. And specifically, let's talk about the Bitcoin ETFs. Why was it important for these to be approved, and what were the roadblocks to get us here? David, do you want to kick us off?
Sure. Thanks, Ron. Look, I think in the first instance, it was really important that we have a way for institutions and retail investors to buy Bitcoin in a regulated manner. And as many people know, institutions have certain mandates, and they were unable previously to buy Bitcoin on spot crypto exchanges. But now that Bitcoin is available in an ETF wrapper, they have the capability of buying Bitcoin. And what does that mean? So what that means is at some point in the near future, someone may be able to buy Bitcoin in their 401k. That means that an institution that manages money that couldn't buy Bitcoin for their customers or for their pensions or for their constituents can now buy it. On the retail side, this is important because people wanted exposure to Bitcoin, but wanted it in a familiar place. So being able to buy an ETF through one of the sponsors, through their online trading platform, or however they acquire stocks, is really important because now it gives them an opportunity to do that. And obviously, I'm a proponent of crypto exchanges, but I also see the value of a customer that doesn't want to worry about security, that doesn't want to worry about having their own wallet, to be able to go on to Schwab or Merrill Lynch and whatever platform they want and go and buy, Bitcoin. So I think for most of us in this space, we have the ways to acquire Bitcoin if we want it, but now people who didn't have the ability or who needed the comfort of a security wrapper now have that ability.
David, thanks. Richard, before I give you the floor, I do want to ask you some questions. I want to give Greg an opportunity to say hello. Greg, thanks for joining us. Good to see you, buddy.
Sorry, I'm the king of being 5 minutes late. My name is Greg Xethalis. I'm the general counsel at Multicoin Capital. Prior to that, I was in private practice for about 17 years, including at the end of 2012 when I started working on the first Bitcoin ETF application, later joined by David in that effort. And represented, I think, grand total about 5 or 6 folks who were seeking to get Bitcoin ETPs over about 9 years before leaving private practice and joining the world of venture capital and actively managed funds.
Greg, welcome to the group. It's good to have you. Richard, I want to pivot the question back to you. You and I go back in financial services quite a ways. Talk a little bit about how you've seen the evolution of ETFs and how the evolution of Bitcoin ETFs occurred. And I guess one of the questions I've had and I always struggle to answer for colleagues is, why did it seem to take so long?
So yeah, ETFs, I mean, for most people around today, are a regular part of their portfolio. The QQQs, the NASDAQ 100, the S&P 500 has many ETFs and so forth. They've really actually only been around since kind of the 90s. Before that, if you wanted to invest in a broad-based portfolio of stocks, you would go for a mutual fund. And that was how people invested for generations. Mutual funds are, they can give you the similar exposure, but they lack the liquidity and the tradability around it. So if you want to trade a mutual fund, you can submit your request to the mutual fund manager and you get end of day pricing, basically. So there's no intraday liquidity. You kind of have to submit your request, I think, before 3 p.m. or something like that. So you don't even know what price you're really going to get either. So ETFs in general bring a whole new level of flexibility. They trade throughout the day on exchanges, on multiple exchanges that we have here in the US. You can get in and out at different prices. Because of this tradability, there's also arbitrage. So you can buy the underlying characteristics of the portfolio. Let's say it's the QQQ. You could buy all 100 stocks, which is basically exactly the same exposure. And you could arb that, but people tend to buy only the top 10, which is 90% or whatever it is. And you can also do things like short them, so you can get negative exposure. You can use them for margin in your trading account. So it brings a whole new level of flexibility. Which is why it's a good thing and why everyone's excited. As Dave said, you put it in your 401k, put it in your IRA. Why did it take so long? Great question. I think, ostensibly, according to the SEC, they wanted to protect investors, and they felt that, there was a lot of, I think market manipulation was one of the main things they criticized in all the applications. They were concerned that there's market manipulation around the underlying spot market. Certainly, it is, we've all been in space for a while. Crypto is the Wild West, absolutely. And there have been, ransomware, although I know this is a minority of the use cases, it gets the headlines. So I kind of, we can kind of see how, that would put certain regulators, certain politicians who are, pulling the regulator strings, let's say, against crypto in general. But when it comes to the, I guess, fundamental statement that they wanted to protect investors, well, what do they protect them from? At the end of the day, they protected them from a increase in price when I think David and Greg here filed the first ETF from about $300 to $46,000. So what kind of protection is that really? I think people need to be able to make, we all know we need to be able to make their own decisions about how to invest. And I think, I don't know if anyone has read it here, if you should, I mean, I'm sure everyone on this call has, but the people watching, you should go and read Hester Peirce's dissent, or not dissent actually, because it was approved, but her comments regarding the approval, saying that we should have done it 10 years ago. We've wasted, we've wasted a decade, and we have soured a generation of entrepreneurs who no longer want to develop in the US. These are all great comments. So your question of why did it take so long really doesn't have a proper answer.
Richard, good point. Thank you so much. And by the way, for anyone in the audience, any SEC commissioner who can cite Shakespeare in their comment post an approval, that's worth the read. Pat, Greg, I wanted to pull you into this part of the conversation. In the early days when we talked about Bitcoin ETFs, and you and David, Greg, were involved in the early days, obviously, as you mentioned, we talked about Grayscale, we talked about some of the, what I'll broadly call crypto native companies. And then over the past, call it 18 months, 2 years, it was not just crypto native companies. So who are the players in the space? Greg, Pat, let me direct that to you, that are essentially household names. Why did they want to be part of this? Greg, do you want to start that off?
Before answering that, can I just follow up on one point that Richard made on the why we saw this delay? So ETFs are really, they're a great piece of financial technology, and they can be a trading tool. One of the reasons why we've had this delay is during the tenure of former SEC Chair Mary Jo White, there were some products that were approved called levered ETPs, or levered funds. And those tools were trading tools that correctly and as disclosed track the price of an underlying index on a daily basis. Investors didn't understand that these were products that, if you held them for more than a single day, could wildly and negatively impact your holdings regardless of which way the index moved. And that's because of the compounding nature of daily returns. So levered ETFs created a whole world of hurt within the SEC framework. Subsequent to that, the AccuShares derivative paired shares or synthetic paired shares ETF approval caused great internal consternation because Commissioner Paris Stein issued the first dissent on a 19b4 order. Both of those things sort of sent the staff at trading in markets into a bit of turmoil and made the process of getting ETFs far more difficult to be approved. And frankly, I think the honest opinion that is shared by a wide number of observers is that neither Chair Clayton nor Chair Gensler wanted to be Mary Jo White with levered ETPs. Now, the difference is a levered ETP is a complex product that is difficult to conceptually understand, even when it does exactly what it is, whereas a Bitcoin spot ETP is actually a relatively simple product and replicates GLD, which is one of the most simple products we have in markets. I disagree with the holdup, but I think a big portion of it is they didn't want to be Mary Jo White and levered ETFs if things went wrong. As players came in, yes, the people who were working on this and on the early days tended to be more crypto native. There was probably one party that sort of sat on the fence on that, which is Jan van Eck and his great GC, Jonathan Simon. Got on the trail early on Bitcoin ETPs and did a lot of hard work. But you did have initially the crypto native firms who are working hard at this, which includes Winklevoss Capital or Digital Math-Based Asset Services. I think NBS was their sponsor. Bitwise, which did a tremendous amount of hard work on assessing the market and really put in a lot of effort. And I'm sure you can guess why I show some favor there, worked with them quite a bit. But you did see a lot of, and then of course, Grayscale and the brilliant Anne-Marie Tierney, who created GBTC in 2013 for Barry Silbert and his crew, later subsequently run by Michael Sonnenschein and Craig Sohm, who built out a private version of an ETP and subsequently uplisted to OTCQX, which was available in brokerage accounts, but lacked some of the characteristics of ETPs, including the arbitrage mechanism that ties the net asset value to the share price. And it really was Grayscale's work that in litigation that brought in some of the other large players. We saw Fidelity, which has had a long-standing relationship with the digital asset industry. They filed their Wise Origin ETP relatively early. But what brought in the titan of the industry, which is the iShares division of BlackRock, was not a 575-1 record for 19B4s. It was the outstanding work by Joe Hall and Zach Zweighorn at Davis Polk and their litigation team that brought the SEC's decision to approve futures ETPs but not spot ETPs to bear in the DC Circuit Court. And that was what these legacy players like BlackRock saw and said, okay, you know what? I think Grayscale is going to win this. And if Grayscale is going to win this, we're going to get an ETP. And for the reasons that David referenced at the start of the call, this is the easiest, most analog way to get your feet wet in the digital asset space, because when you're a sponsor of an ETP, and specifically a single asset commodity trust, you don't do anything except sign contracts. And so Coinbase or Gemini or Fidelity are the custodians. You've got a handful of OTC players, including Coinbase Prime, that are the liquidity providers. But if you're a sponsor of a successful fund like this, all you're doing is sitting back, signing contracts, receiving a sponsor's fee, and doing a little bit of marketing. Or in this case, with this industry, a whole lot of marketing.
Greg, thanks so much. Really do appreciate it. Pat, let me pull you into this conversation. And by the way, kudos for seamlessly letting the cat out of the door, by the way. And all.
No, it's webinars it's a stressful time. It's not as much fun as that kid that ran in last year, or the CNN one. But
yes.
And it's not as much fun as the lawyer that wasn't a cat. So, pandemic brought a lot of great stuff like that, but she had to get out there. Yeah, it was. It's a great. I'll throw in my 2 cents also, because everyone's adding to the cacophony of what it was that took them so long to do this. I'm going to throw in my 2 cents here, which is I think there's a lot of blame to be levered on the SEC here, but what I will say is that there's one of the things that hasn't been mentioned yet is there's this continuing ongoing turf war between the SEC, the different commodities, regulatory agency, the trades, the FTC, every different agency in the US has some vested interest in having a regulatory stance on crypto. And the problem, there was sort of this interesting part of the SEC's perspective here, which is that they, to the points were made earlier, is this, the Bitcoin ETF should have been a slam dunk. There's been guidance for quite a while that Bitcoin was equivalent to a commodity. It's traded on the Chicago Mercantile. Bitcoin and ETH both have been treated like a commodity after I believe it was a ruling 5 years ago at this point. So there was incredible easy precedent for them to say any commodity can have an ETF around it, but let's not have the Dogecoin ETF for a while. Let's put that one on hold and think about it. But we're going to have the Bitcoin one. But doing that, I think from the SEC's perspective, would have been ceding ground in this turf war, which would have said, yes, we acknowledge that this is a commodity. We acknowledge that this is, and they've done that to some extent, but not particularly with great gusto. So would have, saying, oh, this is just a straight commodity that we'll do an ETF for the commodity from there, would have ceded that ground to the commodities, the board, and then which would have then made a lot of the other actions that they do, all this stuff, everything that we talk about that's not related to the Bitcoin ETF, all whether things are a security or not, all of that comes down to this turf war of, does something like, go to Dogecoin. Is Dogecoin fall under the SEC? Is it a security because of how it was marketed? Or does it fall under the commodities because of the nature of how it's mined? And no one really knows. And Congress is still completely lax to actually passing laws. So you saw that the institutional desire to maintain control, where anytime there's gray area in regulatory bodies, they will do everything to both own that gray area, but never let that gray area be specified. It's this really funny part of it, where it's the gray area is power for regulatory bodies, because it lets multiple bodies control the same asset until Congress comes out. And the idea of Congress doing anything this year, again, last year we said this, the year before, but this year is an election year. I mean, there's no way that anything happens.
Nothing's going to get done this year.
No, we're not like we couldn't get anything done last year. We're not getting anything done this year. So it's
Go ahead,
it's that interesting one. But
Thank you, Pat. Go ahead, Suzanne.
I just have a thought, and maybe it's a question for the group as well. Following on from all these great comments, is how much or whether concern around a reliable price discovery was part of the story, because and I know Pat's followed this closely as well with me, how the US GAAP FASB sort of approached things is they had concerns around that, but they really interacted with the industry and got a comfort level around that really, as we all know, in a very short amount of time. And I just sort of wonder, because they talk about it a lot. Oh, the markets are so manipulable. There's, noise, there's wash trade, there's crime, there's this, there's that. And if they finally got comfort that you can get to a reliable price discovery, we all know you can, but was that part of the story at all for those of you who might be behind the scenes?
Yeah, Suzanne, and that's a really good point. And we'll dive into this, you and Pat and I and the rest of the group later on, because the mechanics of some of the things that we're talking about that lie behind approval for things like ETFs is something that's critical. And I know you and Pat are deeply involved in that portion of it. I want to pull Josh into this conversation a little bit. I'm going to slightly rip up the script, Josh, as you're probably used to at this point. By the way, I'm sorry, I want to digress 1 second. So Pat, there's not going to be a Shiba ETF that I should be looking out for anytime soon?
Well, I mean, I would invest in Shiba early is the main thing, but in case it does come, but that's it's fine from that side. But I think one thing to mention here is you asked, what are the major companies getting into crypto at this point? And it's across the board. I mean, every financial service company, I think, we work with Deloitte a lot. And one of the things that Rob Massey over there likes to say is that every single one of their Fortune 500 customers has some blockchain or crypto project. Like there's not a single client that Deloitte works with that isn't thinking about this. Yesterday, just to put that in perspective, I mean, yesterday Hitachi announced they're joining the Hedera Council. Like, this is a car company, a South Korean car company joining a blockchain council. It's and Dell is in that and all that kind of stuff. I mean, companies that are getting into crypto are across the board, and you obviously will see this. Hopefully will start to be a little bit of a trigger to see not just the ETFs, but more additional products. You'll see leverage products and things like that. I know that's maybe that'll be restricted to accredited investors, but you will start to see more and more products that get this into the hands of individuals. Now, of course, where I always fall down this is I'll just throw this out here as sort of the real crypto native guy. There is like this bittersweet moment of the ETF, which is, if you had talked about this 10 years ago or 13 years ago when Bitcoin started this point and said, oh, one day we're all going to be so excited because there's an ETF, I think a lot of people would have shouted you down in the forum, in the Satoshi Talk forum that we were all in there, because it was never the idea was that you should be going back to middlemen to hold your Bitcoin to then go to ETF it. So there's this bittersweet part of it, which is I think it's an amazing moment for folks that don't feel comfortable holding their keys to get into crypto and all that kind of stuff. But it still points to a problem in the overall industry, which is that we still have an industry where my grandma would be hard pressed to go out, buy some Bitcoin and hold on to it, like for pretty obvious reasons right now. So I think we as an industry still have a long ways to go, but the ETF's a great step, and we'll see it's hard to imagine that every major financial institution, the Fidelities of the world, every one of those is going to have some form of structured product at this point that's going to go out there.
Ron, before we hop on, just one point I did want to make, thinking back to 11 years ago, and traded emails with Cameron and Tyler last week, where we talked about this very issue, where yes, the Bitcoin ETF arrived last week, but the benefits to the ecosystem have already been realized. In August of 2013, about a month after the first registration statement was filed, Senator Carper, working with the fantastic John Collins as his chief staffer, sent out an inquiry ahead of the first government hearings, public government hearings, where they attached the registration statement and basically said to 21 federal agencies, tell us what this is. And at that point, the only government agency in the world, other than a few enforcement offices, that had even uttered the word Bitcoin was FinCEN, which released their MSB guidance in May of 2013. It was a completely blank slate on everything else. And what brought this asset class certainty on tax treatment, on Commodities Exchange Act treatment, and yes, even on federal securities laws treatment and many other different areas of law, was in fact the Bitcoin effort, because that set the baseline and the ground rules for how Wall Street and Main Street could engage with this asset class in a legally cognizable way. It's what made digital assets, a capital asset, and brought to bear, how people should account for it on taxes, and can you hold it and how you hold it on a balance sheet. So we got an ETF last week. We've been bearing the benefits of some of the increased certainty for 10 years.
Greg, Pat, good comments. Really do appreciate it. One thing, Pat, that you mentioned, that it brings me to David, and I want to come back to Josh after that. David, we'll get to this a bit later on, but it really speaks to something you and I have spoken about a lot, which is the user experience, the UX of crypto in the marketplace, which is a very complicated series of conversations. But I do want to bring Josh into the conversation as well. Josh, I think you as chair of the legal working group for the WSBA, have spent the better part of 2 years talking about Bitcoin ETFs and problems and delays. And I will admit to being a bit contrary as we approach the end of 2023, and I was convinced it would be delayed. Were you surprised that the SEC approved?
So, I mean, it's funny because thinking back to Greg X offering to eat his hat and eat everyone else's hats, I mean, at that point, I guess, I would have been surprised if it weren't approved, given those strong feelings expressed.
Some hats are tasty, Josh. Some hats are tasty. Fedoras specific.
Yeah, I mean, I do think though, how can I say this? I certainly was not involved in the first or any crypto ETFs. Let's just be clear here. But I do recall, researching it heavily, beginning back, 5 or 6 years ago, and writing some pieces with someone named Jay Barris, who isn't on our panel, but who is really great as well. And I think one of the issues, and this is something that, going back to what was said about the delays, I agree with what folks said. I also just think it's the volumes, right? If we look across government and the moves to try and sort of segregate crypto from the rest of traditional and other, finance, right? I think that that's a part of it, because you can make the arguments, or you could make the arguments till you're blue in the face, right? And certainly folks did in many different forms, saying, look, it's actually potentially easier, safer, many different things if you have sort of a professional intermediary helping, right? Helping individuals. But when you think about the macro effects of the much larger volume of people who may be interested, I think that was a big part of the fear. And I think it does go to things like what Suzanne was saying about, wash trading and lack of price discovery. But I think one of the things, maybe stepping back just for a second, if it's okay, because I don't know whether all folks watching the webinar are aware of this. And certainly when I began looking into this a while ago, although folks like Greg X and David and others will laugh about this, and you too, Ron, probably, I didn't realize that it was actually the exchanges that had to apply for the rule change. I think a lot of people in the market, they don't realize it's actually the exchanges, and that 19b4, right, that rule change that we hear about, it actually relates to the ability to deviate from the generic listing standards that exchanges typically follow. So I think that process, which I won't go into right now, there may be questions later, and certainly folks like Greg X, I think, and David can go into it way better than I can, but I think that provided a really effective gate for the SEC for obviously a decade, right? In trying to stave off the kind of potential effects that Greg was talking about when he talked about the leverage ETPs in the past.
Josh, thanks. And we'll go ahead, Greg. Sorry.
Yeah, I was going to say that's a fantastic point. It's also probably one where it's worthwhile to take a moment to just sort of distinguish between what the different products are when we're talking about ETPs or ETFs. And to Josh's point, so the more traditional ETF that we think of is an investment company, and it's a type of mutual fund that can be traded on secondary exchanges, Spiders being the first of them. But typically when you're buying like an equities ETF, It is actually a mutual fund that has certain exemptive relief that allows it to trade on the secondary market. Those products no longer are required to get a 19b4 because they have class relief under Rule 6b11. There are two other principal types of ETPs. One is an exchange traded note, which is actually a debt instrument typically offered by a bank, and that is synthetic exposure to an identified index. Those aren't particularly popular here in the US. And then the other is an exchange traded commodity, which can take one of two forms. One is an exchange traded commodity pool, which is a futures fund. And we've actually had those in Bitcoin ETF land for a little bit longer. BITO would be the most prominent among them, which is the futures commodity pool that is traded under the 33 Act. There is also a structure that is allowed for those under the Investment Company Act, using a Cayman subsidiary. More famously, there were ETFs launched on Ethereum under the 40 Act. I think about 4 months ago or 5 months ago, and we'll talk about that later. So just, putting a Chekhov's gun out there that's going to come back for us. But then what we're talking about right now are what are called grantor trusts, sometimes called ETCs or ETPs, that are registered only under the 33 Act because they don't hold securities. And these are typically structured as grantor trusts, which means that there's a trustee who has very limited discretion. The portfolio is essentially fixed. And in the case of precious metals trusts or Bitcoin spot ETPs as we have them today, they only do one thing, which is hold and custody the identified asset. Those products are required to register and seek approvals on 4 different ways. One is they have a registration statement, a prospectus on Form S1, registered under the 33 Act and reviewed by the Division of Corporation Finance. There is also a Form 8A registration under the 34 Act, the Exchange Act, which is really more of a check the box, but also is technically a registration statement that the SEC has to be approved, which is done by the Division of Trading and Markets. There is also what's called a trading rules letter and Reg M relief, which is granted by a particular office in the Division of Trading and Markets. Most of those were permitted to receive class relief for these Bitcoin spot ETFs. And then the fourth, and the one that Josh referenced, is the 19b4 process, which is again handled by the Division of Trading and Markets and either voted on by the commission, as done here, or acted on by delegated authority by the staff, which is the more typical process. And I think the 19b4, as Josh correctly identified, it's applied for by the exchange, and it's also an area where the SEC can perhaps put a little more of a talon in the merit regulation category. The SEC is not a merit regulator. They don't have the ability to say this is a good investment for you or a bad investment for you. Their disclosure regime is simply identifying are the risks and descriptions accurately disclosed to the public in the registration statement. But the 19b4 is a more broad hook and one where they kind of sunk their teeth into to try and prevent an ETP coming to market.
Greg, thanks so much. And we'll peel back some of the layers on some of the legal stuff as well. And it certainly does harken back to both the SEC's decision as well as some of the opinions from Chair Gensler and some others. Richard, I wanted to pull you into this conversation. I want to go back to some of the market stuff if I could a little bit. And this is going to sound like I'm queuing up a question, but I'd love you to deep dive onto some of this. And it might be a bit more provocative than I want it to be. Is Wall Street eating crypto? And is this phase 1 for a tokenized world in financial markets?
I don't think I'm going to say also is not eating crypto. I think Pat brought up something earlier, a bit of a bittersweet moment perhaps for some folks about it was all about banking the unbanked and getting out of Satoshi's white paper dropped just right after the global financial crisis about getting away from the financial system and how we're coming back to it. I think that's for the reasons we talked about at the beginning of the call, that's okay. Not everyone wants to custody Bitcoin themselves, and not everyone wants to custody gold themselves. And the other kind of rotation trade now, you got people moving out of Bitcoin into another commodity, uranium. You're actually not allowed to custody uranium yourself. So there's going to be parts of the market who can do self-custody and others can't. And in general, expanding into this financialization of Bitcoin is good for consumers overall. I think most financial institutions completely messed up their strategy around this. I think they're pretty late to the game in terms of getting on board. As somebody said earlier, it wasn't until GBTC, who I think we all owe a lot of credit, even though they annoy a lot of people as well, has done a lot of good bringing this forward and suing the exchange, the SEC and so forth. But what I mean by they messed up, you look at all those ETFs, there's 11 ETFs, and 9 out of the 11, the custody provider is Coinbase. All the financial institutions, or not all of them, but many financial institutions launched crypto custody products which aren't being used. BNY, State Street, others. Fidelity has their own custodian for their ETF. But basically, at the end of the day, when it came down to financializing the product, they didn't go to the traditional custodians, they went to the crypto native one. So I think where the financial institutions should be better playing, be playing, which more suits them, and is something that Larry Fink hinted to last week, is the tokenization of all assets. He actually said, I got it here actually, ETFs are step 1 in the technical revolution in financial markets. Step 2 is going to be the tokenization of every financial asset. So that's what we're a little bit more focused on here. And we're talking about bringing the underlying blockchain technology from Bitcoin to other financial assets. That's clearly what BlackRock is focused on. It's clearly what other financial institutions. Goldman has a digital asset team, and we've seen other kind of leading companies in the space. Citi was saying there's going to be $4 to $5 trillion of assets tokenized by 2030. I think Bain came out with a report recently talking about a $400 billion revenue opportunity. The World Economic Forum and BCG had even higher numbers. I can't remember them right now. But we're talking about using this technology in traditional capital markets. And that is where the financial institutions are going to be able to play. That's where they're going to be able to play better. So yeah, that is something that I think we're all really looking forward to. And it's been, Larry Fink pointing out this is stepping stone. This has really created excitement in the space. And after everything we've gone through with the crypto winter and very much in the doldrums in crypto and blockchain in general, we've got a lot of great stuff to look forward to now.
Richard, thanks so much. And there's so much to peel back in some of the comments from Larry Fink as well. And I think one of the words he used to describe it is that tokenization prevents, and I'm probably paraphrasing the wrong word, the corruption of information in markets. I might be misquoting, but it's interesting that dynamic is the lens through which he looks at global markets now.
He's mentioned a few different characteristics. The first time back in, I think, March 23, he said that the next generations of markets is tokenization of assets. And what he was talking about there, what he mentioned in that same speech, was talking more about being able to have a direct relationship with shareholders, as opposed to right now, the way Wall Street works, everything is in street name. So you will own shares in a company, but the company doesn't know you own them, because they will see their ownership being Charles Schwab, E-Trade, or whoever. They don't know who the underlying shareholders is. That's why we have something called proxy voting. And what that means is that you'll get emails or the thick, regular mails coming to you where you've got to vote on a company that you own, on their shareholder proceedings and so forth. And it comes from your broker dealer. It doesn't come from the company directly, and you're supposed to vote via proxy. So in that scenario, he's talking about, well, if everyone's on chain with their own wallet or identifier owning a security, then we have a direct relationship, and you can enable things like proxy voting. He also mentioned the makes it incorruptible. I think a bit of a bold statement, but what he's talking about there is the immutable ledger, the immutable source of truth, where everyone knows who owns what. The great story around that, or example of where it goes wrong, was Dole Foods, and I'm racking my trying to remember this whole exact story. But anyway, there's a proxy fight, maybe 2016, 2017 or something like that. And the judge said, okay, everyone who owned these shares on this date needs to get paid. And they had, I don't know what the exact numbers are here, but they had X plus something applications for claims for ownership when there were only X shareholders at the time. So they spent a lot of time going through figuring out who was actually owning things. So that's that's another part of the benefits of tokenization that I think obviously sees. And something else he's also talked about is instantaneous settlement, being able to, and this is perhaps probably for the crypto native folks out there, that's what's going to bring in, I think, a lot more, tie together the TradFi and the DeFi worlds, where you can have a security trading on an ATS or on an exchange, and it's instead of settling for cash via your custodian via the DTCC, which takes 2 days. For equities anyway, it takes 2 days. For other asset classes, it can take a lot longer. But instead of that, you can have instantaneous settlement through a smart contract of the security token versus, let's say, a USDC or some other stable coin. So there's a lot of benefits that we can bring to financial services, being with Bitcoin kind of leading the way here.
Richard, I feel like there's a tokenization webinar coming up, and we can talk about blockchain and the duopoly of proxy service providers, which is a whole other conversation. David, I wanted to pull you into this conversation. If we're looking at Bitcoin spot ETF approvals as this kind of watershed moment, you and I have had this conversation for quite a while. You and I chatted half jokingly about Telegram and Slack and text messaging blowing up over the several weeks prior to the vote. Was it buy the news, sell the fact? How did the market respond to all of this?
So I want to answer that for sure. And I want to say one thing too. I agree with Richard that a lot of institutions are catching up, and like at FTI, we're talking to a number of institutions to help them map out their plans moving forward and to really broaden out the crypto and sort of token ecosystem. So going to your direct question, Ron. So it's really interesting. I think that the trade that existed with buying GBTC at a discount to Bitcoin and then seeing with the approval, the GBTC coming to par, really there was a lot of what I'll call fast money that went into that trade. And so I think what we're seeing now is a bit of unwinding of that trade. So we're seeing some more selling pressure than we may have seen, because I think people were short-term trading into GBTC and then selling now that they can get at it close to par. But look, we can't forget that we've had such a major run up in the past 3 to 6 months. And there's so many wallets in profit that I really think that there are people taking profits. And I don't think it's, again, a disbelief in the Bitcoin ETF and in the sector, but I think people, are taking profits. And I think one thing that's also interesting is that the miners are selling at a very high level. And I think that kind of speaks to one is that I think, as many people know, miners sell their Bitcoin to fund their operations. And with the halvening coming up, I think miners are taking some cash in here to make sure that they're properly, financed going into the halvening. But also, I think there's a view that we will have a sell-off coming soon. Some people think we'll go back to 38 or 40. Some people think we'll go to 32. But remember, these are healthy markets. We've had a big run up. So a retracement isn't a viewpoint on the success of a Bitcoin ETF. I think it's just market structure, and we have peaks and valleys.
David, thanks so much. I want to mix up the order that we had all prepped for, and I apologize for that. Pat, I know we're going to lose you in about 15 minutes. I want to spend a little time with you and a little time with Suzanne. When we have these very broad conversations, the legal, the regulatory, the market impacts, and all of that stuff, then there's the mechanics of people buying and selling these Bitcoin ETFs. Pat, let's start with you to the extent you want to speak to this. When we look at things like Bitcoin ETFs and the implications, what are those kind of tax implications, those reporting and compliance implications? And for the rest of the panel, certainly Josh, David, Greg, we'll come back to some of the legal stuff, but I do want to squeeze some of that in because I think it's important for the marketplace to understand.
Yeah, it's a great question, Whit, and it is one. We've been talking about the different benefits of the ETF, and it's one of the other benefits of the ETF is that the implications from an accounting and tax perspective are identical to any other ETF you own or any other asset that looks at as any other ETP asset like this. So it's one of the great benefits of this is that you are not, again, let's go back to my grandma. She's getting a lot of flack today, unfortunately, but my grandma is, well versed in doing taxes on her portfolio. Like, she has a Vanguard and stuff like that. But so she's very used to that mechanism. She's much less used to figuring out taxes on crypto. So how do you pay taxes on fees and all these things that are second nature to folks that are in the industry deeply, but would be like completely out of this world for someone who's not. So ETFs have this great effect where the accounting and the tax implication are identical to every other ETF that's out there, which makes it so much easier for traditional finance groups to actually handle them. And it's gonna, again, and for retail individuals, institutional individuals, all institutions, all of that kind of stuff to deal with these. It's going to be, it makes their life a little bit easier on that side. So it is still harder. I mean, crypto accounting is still harder than normal accounting. Like, it is tricky to do this at scale. It's hard to manage these kinds of things. So it's a great equalizer to let people get access to it.
Pat, to that point, if a Fidelity Bitcoin ETF is much easier to value report on than someone who's got 30 DeFi wallets and doesn't understand the cost basis for something that they bought 2 years ago.
Yeah.
So, obviously one of the things we talk about, Suzanne, I want to pull you into this conversation as well. When we talk about things like asset classifications, the other conversation that we haven't broached here, and it's probably worth its own session, as we look at the public impact, public companies holding Bitcoin, and now we've got financial services providers offering Bitcoin spot ETFs. Is there a challenge in this marketplace as it evolves with financial reporting keeping up? You and Pat provide capabilities in your respective firms to corporates all around the world. What are those challenges, though? How do corporates look and say, well, Ron works for us, he wants a spot Bitcoin ETF in his retirement fund, for example?
Yeah, I mean, I'll hit on something that you touched on first. Sure. That it sounds like broad and not like I'm not answering your question, but I'll get there. And it's the notion of what is the classification? What is this thing? And one of the things that people often don't realize is just because Congress says Bitcoin is a commodity doesn't mean when you get to the tax or the accounting that it is, and I crack this joke sometimes, but it's to get people's attention. Like, Congress could declare Bitcoin a blueberry, but we wouldn't be doing accounting for fruit. We wouldn't be doing tax for fruit, because it's when you get over to the tax rules and the accounting rules, they have their own classification. And so the legal and legal, tax, and accounting can all have a different classification for the exact same asset. And it can also vary depending on what kind of entity it is. Also going to, I'm going to mention Pat's grandma. I could also mention my 87-year-old dad to take the heat off of her a little bit. But are you an individual that's filing? Are you a company that's filing? And I know you are kind of leading us to the corporate structure sort of question there, Ron. But all these things matter. And so you have to be sure that you're paying attention to that you have a good tax and accounting advisor, whether you're a corporate or an individual, that's helping in this context that I'm asking these questions or having to report and comply, what is the classification here? And the noise often in the media is so much wrapped around the axle of, is it a security or a commodity? But that doesn't help you do your taxes. And it really doesn't. That doesn't help you do your US GAAP financial reporting. And so I just ask, kind of throwing that out there to the audience, make sure people are thinking about that. One of the things that is, to, kind of circling back to Pat's point, that ETFs are kind of very similar, whether it's Bitcoin or whatever. If it's on the balance sheet of a company, then there's also kind of, are we talking about the ETF's financial reporting and compliance? Or are we talking about the person or the company that's investing in the ETF? And you'll get a different answer as a result of that question. And in all cases, one of the things that really, really matters is the fair market value or evaluation of it. And how do you get to that? And it sort of is why I asked the question about price discovery early on, because regulators around the world, and I talk to regulators globally a lot, they have been developing over time more of a comfort with the fact that you can discover reliable prices to do the valuation, because the valuation is what ends up on your balance sheet if you're a corporate reporter. And if you also are an ETF, you have to disclose what your index is. What's my benchmark and how did I get there? And you need a reliable sort of approach to that that meets the SEC's requirements. And with the, you know, sort of when I talk about that, and I don't want to lose everybody, I want to say it's the question here for public reporting entities is, are we talking about a benchmark or the balance sheet? Because you can have two different answers actually, and two different valuation approaches. One, you're allowed to use an average or a VWAP, which is the index. The other one,
VWAP, volume weighted average price,
yeah,
for everyone else in the
yeah,
audience. Right?
thank you. The other, when it hits the balance sheet, cannot be an average, generally speaking. That's really frowned upon. And I'm not giving you accounting advice. You're going to go to your accounting advisor there. But you need you need as an ETF potentially access to both that's relying on reliable market information. And as we've talked about, there's hundreds of markets that you can buy or sell Bitcoin on. Which are the reliable ones? How do you narrow it down to those? And how do you then end up with a really solid bit of analytics behind which are these marketplaces that I'm relying on? How to identify a principal market? In a marketplace that is dynamic and changes and volume moves here, frequency moves there. You know, with Bitcoin, obviously it's a bit more stable than as you go further down. But these are all the kind of questions that you're going to want to be looking at as you look for that fair market value, that valuation. And again, balance sheet versus benchmark. Remember, you can take two different approaches.
Suzanne, thanks so much. Pat, one more on this topic, and I think it's really important. You know, for so long, a lot of folks that in the regulatory space, or in what you and I, you know, we all call TradFi, looked at crypto, not substantial enough, really don't like it, not worth it. But as Suzanne's alluding to, like, a lot of the background information is critical. And I had a conversation with a colleague, doesn't like crypto, TradFi guy. He's like, all right, well, the SEC approved, all of this is easy. Well, you know, it's not easy, right, Pat? The information and the work that's required behind the scenes for these providers. How do you explain that to people?
Yeah, I mean, everything with the crypto is a little bit harder than it is with traditional assets. I mean, it's just sort of the nature of it is that these are new muscles that we are learning to flex, and no one is quite particularly good at it. You know, it's where solutions like Bitwave come in, is that we basically allow big financial institutions to track their holdings, do reconciliation at both the transaction level, the balance level, as well as all the accounting work that goes along with it. And we're seeing that we are personally seeing the uptick in institutional demand greatly, which is amazing, because there's so much complexity that institutions are not really used to. And that, you know, even down to the level of, like, you know, the traditional tools they might use, like Blackline for complex reconciliations, don't necessarily support everything that you need to do with crypto. They don't support the notion of NFTs, like an ever expanding list of an infinitely expanding list of security in their master security list. So there's a huge amount of complexity that gets into this. If you are one of the actual providers of these ETFs, and you're sitting on your custodied assets, and you are making decisions about either pricing decisions or buy, sell, buy, hold decisions around it, there's going to be some complexity that gets into it. And I'm not even sure that we've entirely, you know, for the one that I'll talk about that is really interesting is that I'm not sure we've entirely contemplated as a financial services industry what happens when you have 100 or 24-hour a day trading. So 24 hours a day, 7 days a week trading, what that means for ETFs. Because honestly, it's one of the other things I would probably, if I were the SEC, it's one of the things that I would have pointed at, because traditional ETFs obviously have arbitrage potential. I mean, I don't know, it's the funny world is like, this is where Sam Bankman-Fried got his start, was at Jane Street doing arbitrage on ETFs. And they were doing worldwide arbitrage. So they would look at, you know, a Canadian ETF, and they would go, there was buying and selling, you know, Asian assets. They would then go and see what's happening in the Asian market, so they could make more informed moves on the Canadian markets there. Crypto is that much worse, because something that could happen Friday afternoon that completely upends the entire crypto market, and suddenly you have this rush to Monday morning when your ETF is going to be completely sideways in pricing. So, you know, you can imagine there's issues that we haven't dealt with at a structural level around how we handle this incredibly arbitrageable, high velocity asset that's trading 24 hours a day, 7 days a week. So there's a lot of muscles to be built by all these institutions that get into both on the Jane Street side in terms of how they actually play that market, how they play the ARB side of the market, as well as the ETF holders themselves on what they do, how they track their assets, how they make sure they are in compliance, how they're reporting on it. I mean, the reporting guidelines for this are not even that particularly clear. I mean, there's obviously accounting reporting guidelines, but the SEC work was all under extreme duress. I'm not even sure there's very clear SEC reporting guidelines on what your balance sheet is and all that kind of stuff. So.
Yeah, Pat, really good point. And I know we're about to lose you soon. They just told me they've fueled up your Gulfstream.
Yeah,
You've got to head out. I want to give you 30 seconds for a real quick last question for you. I'll ask everyone else on the panel this question towards the end. What's your one prediction for 2024 before we lose you before you head out?
Oh man, what a terrible question. My last prediction I made with you, Ron, was Bitcoin hitting 100K, and I think it was 2021 or something.
That's right.
And that was like the year of the Great Depression on it. So I will try my best not to make it. I think we're gonna see I'm gonna make probably like an obvious prediction, but I think we actually will see one of the major financial institutions get real serious about this. Everyone has their toe in the water, the fellows at JP Morgan's, everyone has their toe in the water. JP Morgan has Onyx, so they're a little bit more invested than others. But I think this is gonna be a year we really see how about this one? I think we're all used to seeing the grayscale ads in various places. So whether it be airports, or I think they had a Super Bowl ad or something like that. I think we'll see one of the major traditional TradFi players do some sort of marketing around a Bitcoin asset which would be a major step. Like that's just like one of the TradFi people marketing Bitcoin will be a major step. And kind of scary in terms of finance eating crypto, but that's my it's not a huge prediction, but I think it would be a really interesting thing to see.
Pat, thank you so much. Josh, I know you've got a quick comment you want to weigh in there, and then I want to pivot to you and David and Greg on something, but Josh, go ahead.
Sure. Thanks, Ron. I just wanted to respond to something that David had mentioned earlier about, people selling, right, to take a profit, or miners preparing for happening, things like that. And I just clearly David's been right with his crystal ball from our weekly crypto roundup predictions, not investment advice or legal advice. But I would say, what we've been hearing just from around the world, really around the globe, from banks, is that their customers now post Bitcoin spot ETF approval have really been asking and showing great interest in entering into this. So I don't think we've yet seen, even though the ETFs are trading, right? I don't think we're seeing the volumes or the demands, because there's still this process of like, oh wait, what is that? It's approved, and that I think that's going to take some time. I mean, one person shortly after the Bitcoin spot ETF had been approved was saying, this is great, but why would you have an ETF with a single asset? And I had to say, well, what about gold? And the person actually said, oh yes, I have a gold ETF, right? Like I own that. And so I think part of this is just this educational process. And so I think, yes, I agree with David about, the sell the news type thing and taking some money off the table, but I think there's so much going to be coming in.
And Josh, you and I have had this conversation. It's a really good point. I've had so many non-financial folks seem to conflate mutual funds with ETFs. And again, I agree with you. Take care, Pat. Good to see you. Enjoy the Gulfstream, buddy.
Happy ETF day.
Happy ETF day. Josh, to that point, I think there's so many folks who are kind of conflating mutual funds and ETFs. And again, education is critical. David, Richard, Greg, I want to pull you into something. One of the things that often came up in the conversations over the past few weeks as we were approaching ETF day was this idea of the mechanics of it. And one of the things that apparently the SEC pushed back a lot on was the difference between cash settled and in-kind settled. David, do you want to kind of kick us off on that conversation? And, there are folks in the crypto space, and you and I received the messages that were, this is terrible. Why are they doing this, et cetera? I didn't think it was that big a deal. I understand the mechanics, but David, for the audience, what's the issue there?
I want to pass this one to Greg. I think I want to let him talk to this, but I will say this. I want to talk about something Josh said. I totally agree that there is a lot of interest and new money that will come into the crypto space. And I think one thing we all have to remember is that just because an ETF is approved, the mechanics of it take time to get to your online brokers, to get, for pension funds to really kick the tires on it, to see the performance, to make sure that it's tracking with the underlying spot. So I really do think that we will, over the course of the year, see more liquidity coming into crypto, and even into your potentially retirement funds. Like your retirement advisor has to look at it, evaluate it, may need to change their mandate a little bit. So I think we have the ETF, but I think there is a process by which it becomes accessible to everybody, and it's definitely not overnight. So I do agree that we're going to see more liquidity coming in. But I want to pass this question off to Greg, because I think it's an important distinction.
We'll give Greg some airspace. Greg, please explain to us cash versus in-kind. And I know, Suzanne, you and David have some other comments there as well. But Greg, what are we talking about when we talk about this stuff?
Yeah, so most of the physical precious metals trusts and a good number of other exchange traded products operate on an in-kind basis. There are certain tax efficiencies that flow for the authorized participants who can, and also arbitrage efficiencies that sometimes it's easier to arbitrage the distinction between the trading price and the net asset value price if you can go out and acquire the asset on your own for subsequent delivery. But what we mean by in-kind creates and redeems, it starts with first the concept of what is a creation or redemption. When you're comparing this to mutual funds, we discussed earlier, you're interacting directly with the fund, and you're buying in cash at end of day 4 p.m. NAV strike directly from the fund, and you're not trading in the secondary market. It may show up in your Schwab account or your E-Trade account, but you're buying directly from the fund, and you're creating redeeming directly from the fund. ETFs are different. The only people for most ETFs who are able to create and redeem from the fund are large broker dealers, the Jane Streets of the world, the Virtues, the Goldmans, and so on, who act as something called an authorized participant, which is a broker dealer who has the power to create or redeem shares, typically in something known as a creation unit. And those are typically in the amount of about 10,000 shares to 50,000 shares. And it's denominated in that amount. So you can redeem 3 creation units or create 5 creation units. Just has to be a multiple of a creation unit. Only those large broker dealers can do that. They do it on a daily basis at the end of day, and they do it in an in-kind format by delivering the underlying asset and receiving the shares in a creation, or buying the shares on the secondary market, delivering those and redeeming the underlying asset. And the way they do that is how net flows occur for the fund. If a fund is trading at a discount to its underlying NAV, then APs will buy shares on the secondary market. They will arbitrage and hedge the price exposure of the underlying and the shares using derivative instruments typically, and buying the assets where possible, and then deliver those at end of day and capture that premium or that discount. And that is what arbs the discount away to the underlying NAV amount, so that the trading price and the NAV is equivalent. If the shares are trading at a premium, what an AP will do is they will create shares. They will go out and buy the underlying asset, deliver it to the fund and receive the shares, trade those into the secondary market, hedge their price exposure, and get a riskless arbitrage on the trade. That is how assets flow into and out of an exchange traded product. It's not someone saying, oh, over the long term, I think this asset is going to perform well, so I want to buy a lot of shares as an AP. That occurs on the secondary market. The APs are purely operating on that price, which is one of the reasons why, I don't remember if it was Josh or David, talked about the flows that will come into this will take time. And it's because the flows are directionally driven by the discount or the premium to shares. We currently see a discount for GBTC. We currently see a premium for the other funds. That's somewhat rational for a number of reasons we've already sort of touched on. But now what we have here is the SEC has said this can only be done in kind. Now, why are they doing that? Now, I have my suspicion because I'm opinionated, like to talk and often speak on those thoughts. And I believe what's going on here is that the SEC has for about 6-7 years refused to provide comprehensive guidance on broker-dealers. And I want to make a comment also. I've been working with the staff on Bitcoin-related issues and crypto-related issues for 11 years. The staff have done exemplary work by and large. Most of my criticisms of the SEC, where I have criticized, have been 10th floor issues and policy decisions rather than the staff work. The staff has done a fantastic job. The ETF rejections, although I disagreed with them, were very well written by the team there. And there have been some fantastic people we've worked with on crypto-related projects, including those who have gone to the open market. Early actors on the Bitcoin ETF process included Karen Ubel, a partner at Goodwin and the head of their group there, and Coy Garrison, formerly Hester Peirce's GC and now a partner at Steptoe, both fantastic lawyers. There are others, Neil Mitra and others who have worked on it, and a number of folks who are still at the staff. But the reality is we're 7 years in for a request for clear guidance on how broker-dealers can engage with digital assets. And the rub here on in-kind creates is the people who have to deliver those are the authorized participants who are broker-dealers. Now, the contra to this, and Richard, we talked about the jurisdictional war and the land grab for having authority over these issues. It's not clear to me that from a policy perspective, the SEC actually wants oversight over these markets, because if they wanted oversight over Bitcoin creations and redemptions, the fund is a registered vehicle, but it is not a regulated vehicle. The people who are regulated are the authorized participants. By preventing them from doing in-kind creations, what we have done is pushed the sourcing of these Bitcoin to liquidity providers who are not regulated by the SEC, i.e. the exchanges and what have you. And it's the fund itself that has to buy and sell Bitcoin. And what it receives from the APs at the end of day is cash, or delivers cash. And we've actually made this product more susceptible to manipulation and less susceptible to SEC and other regulator oversight by preventing in-kind contributions, in-kind create and redeems. It actually means the fund has to purchase between the end of day and 1 day and their settlement cycle, which is somewhere between T+0 and typically T+1, sometimes T+2, T+3, but the settlement cycle is shortened. So you've actually pushed it from parties who are more sophisticated at trading, the APs, doing the sourcing and selling of Bitcoin and the hedging of that price, and instead forced it into fund purchases and sales, which makes the exchange traded products less efficient. It makes it less easy for the APs to do creates and redeems. It's simpler when it's in kind basis. It is more of an outlier. Like GLD doesn't do this. GLD does not have cash creates. They have in kind because it's the more efficient way of doing it. And it's just a worse product. And counterintuitively, it gives the SEC less oversight and regulatory authority over this. Now, there's a bit of a disconnect with shareholders who sometimes thought that, okay, GBTC becomes a true ETF. I can take my 30 shares and redeem them and get the Bitcoin back. That ain't in the cards, but to be honest, it was never in the cards because it's only the APs who can do it, and you have to have a creation unit of 10,000 shares for GBTC. There are a handful of funds in the precious metal space, specifically those offered by Sprott, which is a Canadian issuer, which have something called retail redemption. It is possible, but very few funds actually have that. It's easier to do for digital asset ETPs, but it's not likely, and it's not in the near-term cards. That's just
Greg, thanks. Greg, thanks so much. Richard, David, weigh in on this. And that redemption mechanism that Greg did a great job of explaining to us, is that by design?
Well, certainly, that was a very good explanation of a very complicated and nuanced subject. So congrats on that, Greg. I think.
Yes.
Yeah, that's great. Well, it certainly sounds like it's by design. Greg was pointing out that it gives the SEC less control over the spot market. But I think it's probably driven by the fact that they didn't want broker-dealers, who they do regulate, to be trading in the spot markets. I think there's a couple of relevant, not much to add to what he said, but a couple of relevant points is that this create-redeem process is one of the beauties of ETFs, and is why you will get the price of the of the financial product much closer, within a fraction of a percent to the underlying spot Bitcoin price. You did not have a create redeem process with GBTC. There was no redeem process whatsoever. In fact, GBTC, they could have applied for kind of periodic exemptions. They didn't do that. They wanted to go for the full ETF. So that's why you had at one point a massive premium, which is the Widowmaker trade, where the GBTC was 40% over the price of spot Bitcoin. And then when everyone who was in that Widowmaker trade like blew up, like Luna and whatever, it went the other way to a discount. So a lot of GBTC holders have been sitting on a discount for years here, a couple of years at least anyway. I think the other important point around the deliverability, not so much for the cash ETF, the spot ETF we're talking about here, is the previously approved futures ETFs, which were also cash settled, which has been proven to lead to increased inefficiencies. And I think there's actually a better argument for having in-kind settlement on the futures ETFs, because that is a valuable product that a Bitcoin miner would want to use. So they're mining, and they're going to want, or they know they're going to be mining for the next 3 months, 6 months, and they want, if there's a good price in the futures market, they want to be able to lock that in and deliver their Bitcoin, which is exactly the same process of how a farmer would work. If he sees a good price for wheat on the futures market in April, he may want to lock that in for the September delivery, and he'll deliver. That's how he'll be able to hedge his mining or farming, whatever you want to call it. Yeah. So I wonder if this is going to change going forward. I mean, one of the things we haven't talked about yet, maybe I'll bring it up, is there's an election coming up this year, 2024. And it didn't used to be the case, but crypto used to be fairly bipartisan, but in the last few years it's become, Republicans are much more pro-crypto and Democrats are much more against it. So, it could change. There's the potentially new SEC chair by this time next year.
Richard, thanks so much. And I do see some Q&A coming in. Folks in the audience, thank you for staying with us. There's so much great content. If you do have questions, we'll queue up the last 10 or 15 minutes for Q&A, so please do provide them. David, weigh in on the comments and the commentary that Greg and Richard made as well. And I do want to pivot with you specifically and Josh to something, but please weigh in on some of that.
Well, the great thing is with having panelists who are so knowledgeable that Greg really summarized things, better than I could. And I appreciate that, Greg.
I just nod when Greg talks at this point. He's right. I'm with you.
I learned a lot from Greg when we worked on the first Bitcoin ETF filing back in 16. But no, Richard really hit it on the mark. I really think that the cash redemptions really just amplify the inefficiencies in the market, both for the futures products, which really in kind would be perfect for a futures product. Think about airlines, think about the Bitcoin miners. So I think it's an unfortunate byproduct of the approvals. And I just wonder if the commission doesn't want other parties custodying Bitcoin, whether it be banks, the APs. I think that's really the secret sauce behind why they're not doing it. And so, it's ironic because it is creating inefficiencies. It's not the best price for individuals or institutions, but I think it's this sort of methodology of the commission that's getting in the way of that.
I feel a SAB 121 comment coming. Go ahead, Greg.
Yeah, I was going there. What I would note though also, there was a fantastic paper about hybrid DeFi done by a crypto lawyer named Eric Hess, who also hosts the Encrypted Economy podcast. And it was a really good paper in large part because, and this goes to Richard's comment about the political nature of this, that a lot of the current regime, and this also still, I think, harkens back also to the regime that preceded it under Trump, there had been a lot of focus on systemic risk and the potential systemic risk that crypto could present to the traditional financial system. I tend to think that is perhaps overstated, particularly because financial institutions tend not to run headfirst into new technologies and new applications, but tend to test it out. And when I was in private practice and representing some of those financial institutions, that certainly played out. But there has been a lot of focus on systemic risk, and we see that in a lot of the regulation from the SEC side, from the bank regulators, The Fed has been focused on this. After Luna blew up a year and a half ago, or thereabouts, time is a flat circle in crypto. We saw Jay Powell testify before the Senate and saying that, you know, Luna and DeFi doesn't really flummox me because it doesn't present, it's not interconnected with our financial system, and it doesn't present a systemic risk. Now, the only area where a systemic risk really reasonably can even be perceived as existing is in stable coins, but that systemic risk, I think, is greatly overstated because of just the way they function and what they hold. And I think regulation of those stablecoin issuers would mitigate that. But I do think, and Suzanne, I think you may have wanted to talk about SAB 121, like that is reflective of the fact that the SEC, from a policy perspective, there is a jurisdictional fight, but that jurisdictional fight is seems to be to say, we have this magisteria, it belongs to us, and we're just saying you can't do this here. You might be able to do it in small de minimis amounts, and maybe it's with Bitcoin, but not other stuff, because Bitcoin's not a security, which they have actually publicly said in the Cipher Technologies Bitcoin Fund correspondence file. They've actually gone on the record and said that Bitcoin is not a security in working purposes, which people don't often realize. But like SAB 121 seems to be them saying, okay, this is possible, but you can't do it here.
Greg, thanks so much. Appreciate it. Suzanne, I cut you off earlier. Floor is yours.
That's okay. Before I
You're
say
on
something
mute.
about SAB, oh, sorry. Can you hear me now? No, can you hear me? Okay.
Yes.
Before I say anything about SAB 121, which I referenced in a recent Bloomberg op-ed piece, but I want to just go back really quickly, something David said, and I think everyone's sort of touched on, but it is really important, in my opinion, this is my personal opinion, that people read the filings for each of the ETFs that are on offer. They're not all the same. They aren't designed all the same. Their metrics that they're using, for instance, these benchmarks, which, you know, going back to Greg's explanation, the benchmark is how you, and Richard too, how you decide if you're tracking well to Bitcoin or not, how the ETF can convey that they're tracking well. So choosing the benchmark, it is laid out in all the filings, as well as then the balance sheet part, which I think is a lot more stable and reliable, you know, than not. And the FASB has said that as well. And the SEC has alluded to that in SAB and SAB 121, because they're forcing anyone that is got wallets of customers to potentially come up with a fair value of all of the crypto assets in the wallets, even if they, you know, and so I think fair value is a really good standard, and you can get to valuation. You just need the right tool. You need the right provider to help you get there, who can handle all of the analytics that goes with figuring out a reliable price, you know. So, but SAB 121, I agree. I think it was sort of really trying to discourage people from or entities from being in the position, and it was you know, a staff accounting bulletin is an interpretation of US GAAP, and it bypasses the FASB, who owns US GAAP. And so one of the things that came out as long ago as 2008, when SEC's own committee on financial reporting issued a recommendation that the SEC not issue staff accounting bulletins, and instead, if there's an issue at hand, refer it to the FASB, because then you have the full public discourse and discussion and voting and deliberation. And so I think it's an opportunity I would hope for, if I'm going to maybe jump to my prediction or hope for 2024, is that something called an emerging issues task force agenda item end up on the FASB's agenda that tackles the SAB 121 issues, because if it just needs a more fulsome sort of public sort of debate there. And so I'm sort of co-opting it and then getting ahead to kind of predictions, which maybe I'll end with my prediction, if
Sure.
that's where we're headed, or my hope is I do think we're moving toward more regulatory clarity and certainty in the areas that I track and follow globally that I think is helpful for the industry. It's not there yet. It's not as good as it could be, but that's one of the things where I spend a lot of time, and I think that will help the industry and sort of help folks who are interested in the industry. And I'll
Suzanne. Yeah, no, I appreciate that. Great points. And for the audience who may not be aware, there's still controversy around the SEC Staff Accounting Bulletin 121 because the Government Accountability Office claimed this was a rule, should have went through Congress, you didn't do it, and then nothing changed. So I suspect SAB 121 will come up. I've got a couple of real quick things. Josh, I want to pull you in here. I'm going to pivot a little bit. We've mentioned the word political a few times in the blizzard of news afterwards. A senator who shall remain nameless came out and said that the SEC was wrong in approving these, wrong in the law. And my head kind of exploded when I read that because it was law and the judiciary weighing in on law that kind of pushed the SEC to approve. What do you make of these kind of political statements, Josh? And what do you think there? And, obviously I want to open this up to the rest of the panel as well. What do you think that does to the industry?
What it does to the industry? I mean, I think in a sense, some of these comments actually has the effect of galvanizing the industry, right? When you see them and you're without taking any particular view about the maker of the statement or the statement itself. I mean, certainly, I think sometimes statements can be made that kind of divulge that the person making the statement is basic. Oh, that's my dog in the background joking. Doesn't particularly have that close of a finger to the pulse and is more potentially politically motivated. I did want to add just one thing to the systemic risk part. Is that okay for a second?
Yes, please do. I just saw your message. Sorry.
So in addition to SAB 121, which we've talked about, and just building on what Greg was saying about the systemic risk, which I really do think keeping things separate has been a strong goal, right?
Yep.
If we think about, say, the OCC, right, holding aside whether the banks could do something, right, the OCC has said that banks need prior approval of their regulator before engaging in digital asset activities. So we saw that earlier last year after Silvergate and SVB and all of that, and people were decrying the unbanking of crypto. People realized, oh, wait, the OCC has been giving this guidance for a while. And in fact, when SoFi Technologies acquired a national bank a few years ago, they had to discontinue their digital asset activities. So I do think a big part of this cash push is, as was stated by others on this panel, the idea of trying to keep it out of, keep banks from being involved in such a way. But I do one quick final thing.
Go for it. Yeah.
Which is, and this isn't a prediction, it's just more of a question. I mean, I recall in 2017 with the approval of the futures, right? The Bitcoin futures. I recall a lot of statements being made saying, oh, of course they approved the futures because it's cash settled. And I just wonder whether, looking now and seeing that we finally have the spot ETF, what was the justification for the futures back then? I'm sure others on this panel have much better answers to that than me.
But I think, didn't one of the courts say that as well? Like, what's the difference if you're proving a future that's based on the spot versus just approving the spot anyway? I think that came up in one of the court cases, so I don't know.
Yeah, good point. So we're running close on time. Thank you all so much. We do have a couple of questions. Greg, I know you've answered some of them directly. I do want to answer them verbally for the rest of the audience. So with everyone's permission, we'll dive into some questions here. And I know Jason had a great question early on. Greg, would love you to weigh in on your answer. How long until the ETF is approved? Is there going to be a cascading effect? Greg, you want to start us off and certainly get everyone else's answers?
It ain't going to cascade that far, but there probably will be a cascading effect. So one of the principal elements that's basically required to satisfy 19b4, or rather the Section 6b5 requirements under the 34 Act are basically a liquid futures market is how every single ETP that isn't securities based has basically satisfied that requirement of regulatory oversight. of the underlying market. There's a separate 3 sets of webinars on why this approval was very weird and the prior rejections of it were very weird. But needless to say, the core point is there has to be a liquid futures market around it. We've had Bitcoin since November of 2017. We had ETH futures the year after. There aren't any other liquid future markets for crypto assets on the CME or the CBOE or any other large US market. So we're talking about ETH and Bitcoin and mixes of those where those are the predominant assets. In theory, you could get to perhaps some of these blended indexed assets where Bitcoin and ETH are the predominant amount, but we're basically talking about ETH ETPs, Bitcoin ETPs, probably ETH ETPs, and then maybe iterations on those, like we saw Grayscale file for 1940 Act ETF with Bitcoin and covered calls. So the only 2 reporters who have really done a standout job on covering the crypto ETP race are Eric Balkanis and James Seyfarth from Bloomberg, and they also do a fantastic job of tracking timelines. Van Eck has their final deadline for approval or denial on May 23rd of this year for their Van Eck Ethereum ETF. ARC 21 shares has one the day after. Hashdex, Grayscale, Invesco, iShares, and Fidelity all have subsequent dates that follow. Under Dodd-Frank, the Exchange Act now has a 240-day calendar between the publication in the Federal Register and the date at which the SEC must approve or deny a 19b4 application. Otherwise, it is deemed to be approved. We saw them approve the Bitcoin ETPs on day 240 for ARC 21 shares, which was the first one up. We should expect the same calendar for Ethereum ETPs. It should be noted that Ethereum ETPs are a little different. First, under the standard that's been set with this approval, there has to be a strong correlation between the spot and futures markets. I suspect that will be found, but we don't know that to be the case. There also are other weird quirks that could come up with Ethereum that cause distinctions. One that probably won't is an argument that Ether is a security. And the reason for that is right before the potential government shutdown, the SEC's Division of Investment Management accelerated 7 Ethereum 1940 Act filers. They took affirmative steps to allow them to trade, not simply allowing them to go live on their own. And to the extent that they did that over an asset which is incorrectly categorized as a commodities-based future instead of a securities-based future, that would be very abnormal. That to me seems like a concession that Ether is not a security. And if that's the case, and if there is a correlation, we likely will see Ethereum ETPs this May. No guarantee.
Greg, thanks so much. Greg, thanks so much. I want to be cognizant of time. I suspect there's going to be an ETH ETF webinar that we have to do. I want to give closing comments / predictions to our panelists, and thank you all so much. Josh, you have any closing comments or predictions? And I know we've got a lot of work you and I ahead, but would love your thoughts.
So beyond what I've said about expecting additional inflows and things like that, I really will yield my time to others who are very in the weeds and also in the skies on these issues.
David, how about you? You're on mute, buddy.
I was looking forward to this part. So Greg was channeling me, and that one of my predictions is that we will see an ETH ETF in 2024. I think we will see a new high in Bitcoin. I also think we will see some excellent guests on our crypto roundup every Friday and some interesting analysis. And I hope some of the guests here today will join us on future podcasts. And I also think that there's going to be a lot of M&A this year. I think there's going to be a lot of money flowing into crypto again. And I could really see some companies that maybe haven't been in the space acquire, companies that are in the space or combinations of different products. So thinking that there's going to be more M&A and candidly, I've heard from people generally that people are kicking the tires on certain projects.
David, thanks so much. Richard, your closing comments / predictions, if you care. If
Yeah,
you
great
care to.
predictions from David there. I'll just say to everyone, keep an eye on tokenization of real world assets. That's a big theme right now. My prediction is an easy one, I think. Grayscale will cut the fees on GBTC by at least 50%, probably not even by the end of February, never mind the end of 2024.
Richard, thanks so much. We'll do Greg, and then I know, Suzanne, you're waiting to head out for a drink at the pub with some colleagues, as I recall. Greg, closing comments / predictions.
I will take the other side of that GBTC fee cut, Richard, and
Okay.
and I think
Wow.
they will launch a second fund that was predicted by James Seyfert, and a lower cost fund but keep their fees. Rather than a prediction, other than that, I just want to acknowledge Kathleen Moriarty. She was my mentor for 17 years. She is the woman who invented the legal side of the ETF industry, Nate Moss being the head of Amex, who invented ETFs as an asset class. Kathleen did spiders, she did GLD, she did Wisdom Tree, she did everything. She also was the woman who did a lot of the legwork to make a Bitcoin ETF happen. She unfortunately passed just over a year ago, but her legacy is felt without question throughout the multi-trillion-dollar ETF industry. It's felt throughout the crypto fund industry. And it's incredibly deeply helped throughout my career. So just want to acknowledge and thank her one more time.
Good acknowledgement. Really important person in the field. Greg, thanks so much. Suzanne, round us out.
I got nothing. I did mine at the top, so I'll leave everyone here a little earlier. So I'll leave everyone. So thank you.
Excellent. I want to thank you all for your great thought leadership. We can keep going. There's so much to do here. Thank you for everyone in the audience who stayed. We went over even the 90 minutes, which is another great session. Thank you all. Tomorrow at 10 a.m. for anyone who's interested, the WSBA is hosting a listen party, SEC v. Coinbase. You can actually dial into the court proceedings and listen to the request for judgment. I believe if you could join us at 10 a.m. Eastern, drop a note to info@wsba.co. Hope to see our members and colleagues there. I'll leave it there. Thank you all so much. It's always a privilege. I learn from each of you every single day. Until next time, have a great rest of the week.
Thanks, Ron.
Thank you all.
Thanks, everybody.